Well, a couple of them. The first one has come in from Citi, and they have also increased their target on Nifty, though they have also rolled forward the date of the target to September 2025 from June 2025, and they have increased the Nifty target to 25,000 from 24,400. But sector specific, if you see, they have downgraded autos to neutral from overweight, and this is on the back of three reasons. Firstly, of late we have seen a strong outperformance in the sector. Apart from that, they're expecting growth to moderate going forward, especially in the PV and the CV segment, that is the passenger vehicle and the commercial vehicle segment, and they're also expecting margins to moderate going forward, and they're saying that current margins are at a pre-COVID high, and they're expecting some moderation going forward on the back of rise in the commodity prices. So these are the basically three reasons why they have downgraded auto, and their key overweight when it comes to PSC, utilities, defense, industrials, banks and insurance, while they're underweight on consumer discretionary, IT services, metals, and they have also added Industars to their preferred list of stocks, that is Citi. Now, interestingly, JPMorgan has also downgraded its rating on auto to neutral from overweight, and they are also mentioning the same reasons behind this downgrade. And on the other hand, they have upgraded consumer staples when it comes to this space to overweight, as they are saying the valuations are reasonable. They are expecting strong outperformance going forward on the back of good monsoons, contained inflation, and upcoming festive season. Now, for auto, they have specifically mentioned that Q1 was probably the last quarter with a favorable base. So a negative base will also be one of the reasons why they are not preferring autos going forward. And apart from that, they are saying that they are recommending a barbell strategy where they're playing defensive story through consumer staples and healthcare, and this is from a tactical standpoint. But from longer term, they are still preferring capital expenditure story via industrials, real estate, and financial sector. So two downgrades coming in for auto sector, Nikunj.
And this is exactly in line with, I think, what we were discussing last week, that look, there was a time when you had to really wait and wait and wait for that car to be delivered. Now that is not the story. Now the demand supply equation clearly is in favor of the buyer, not the seller. So for auto, whether it is the base effect, sheer competition, impact of inflation or capacity addition, all of them are at play. So auto is no longer the sector where, in a sense, where there is high demand, but in fact the demand base now seems to be plateauing. Discounts are coming back, and looks like we could be in for okay festival season. That is what channel checks are indicating. And also for auto stocks, valuations are not exactly very cheap. These are businesses which are in the range of about 15 to 18%, and when these stocks, they start trading at P multiples of 40-50 times current year, you would ask yourself that for a cyclical business, is that deserving? However, the other bright part is that suddenly everybody is getting bullish on consumer staples. That P logic applies there also, that they are also expensive. But I think there is a case for a tactical trade there, because monsoons are good. Inflation base effect has kicked in. The volume growth seems to be making a comeback, and commodity prices have decisively started coming down. So for that extra, alpha in your portfolio in the near term, which is next 3 or 6 months, I think we are in for more surprise from consumer staples and more disappointment from autos. Auto is going to give you more disappointing news, and consumer staple will start giving you positive news. We've seen that with Colgate numbers. We've seen that with Britannia numbers. We've seen that with Britannia numbers. So 3 to 6 months, good old FMCG consumer staples will surprise you, good old autos will disappoint you, and that is what I think is evident looking at what we were discussing even in the newsroom last week.